All right, so thanks everyone for joining us. I'm Ryan Dietrich. I'm CEO and founder of Sharp CFO, joined today by our area president, Mr. Rob Simon, and Charlie Filisko with Marsh. And topic today we're going to go over is what a hard market is and what it has to do with an insurance premium and why you should really care about it. We were just talking a little bit ago about a real live example of why we should all care. And it's really, one of those things they don't really, as a small business owner myself, I mean, there's some things that you think about, some things you don't, and they don't teach you about insurance in college, and you kind of learn in the real world, So I'll hand it over to you guys and, let you introduce yourselves further, and, we'll just get started in the discussion. So, all right, go ahead, Rob.
All righty. Well, thank you, Ryan. So I'm Rob Simon, obviously with Sharp CFO as well. And I've also been a CFO in business for over 21 years. And I know from my experience, I mean, that insurance can be a pretty large expense for a business. Certain industries are going to have a higher cost just off of their insurance ratings and what they do. And that you need the proper structure. It needs to be in place and to be in guard and to monitor the coverage and to monitor the expense. So I'm really interested and happy to have Charlie from Marsh McLennan with us today to kind of go through this and offer give you some points on what's occurring in the marketplace insurance wise, particularly as probably we get through the third quarter, the fourth quarter, and renewals are going to become time for those. So just give some points and some ideas beforehand and to get going. So Charlie, I'll let you kind of get your introduction out and we can get going.
Absolutely. I'm Charlie Filisko. I am in the Cleveland office of Marsh McLennan Agency, which is the middle market arm of Marsh McLennan Companies. As far as my experience, I've been doing this for the better part of a decade now. And this is unfortunately the first hard market that I have been through personally. So as far as different changes and different events that are occurring, it's fresh for everybody because the last one I believe was in 2001. So, but moving on, as far as what actually is a hard market, it's essentially just a market in which limit availability is lessened substantially. Insurance carriers get significantly more conservative with their underwriting approach, as well as pricing terms do go up accordingly. So there's a couple of reasons why this has occurred. So partly it is environmental aspects with regards to catastrophic losses, wildfires in Australia, wildfires in California, floods in Houston, hurricanes in Florida, hurricanes in New York, New Jersey, all around the eastern seaboard, which is depleting the reinsurance capital that is essentially just what insurance carriers buy. So there's actually a third tier of this where it's retail broker like myself, insurance company, which is, your standard Travelers, Cincinnati, whomever that may be. And then there is different insurance companies like Swiss Re and Canopius and whatnot that are actually reinsurers that insure the insurance companies themselves. Now they have been more affected by losses over the last couple of years because of the catastrophic claims that were previously mentioned. Other impacts like social inflation have occurred, which is essentially the increase of jury verdicts for cases against corporations and things like that. So once you have sympathetic jurors, then all of a sudden the verdict gets substantially higher than it could be. So maybe that $10 million umbrella actually does end up being called in question in total from a jury verdict perspective. So those are some of the aspects of it. Other things, depending on what line of coverage we're talking about as well, are auto, increase in technology with distracted drivers. And then there's the other theory as to what is also occurring. That is, we may have been at a false premium from an underwriting perspective for the last little bit of time. So basically, if investments are good, then insurance carriers can underwrite less specifically, let's call it. So ultimately, they look at it like more premium dollars is better from an investment perspective comparative to it being we're underwriting this to try and profit off of this specifically. So when investment dollars are not as effective in a down or lowering economy or any sort of speculated lower economy, that affects it on top of just general competition. With enough insurance carriers, enough people wanting the business, insurance underwriters can do silly things. And silly things mean charging on an auto basis per auto $400 per unit. Now, I can tell you from my personal experience, there's really no situation where there is a medium or light truck that only should cost $400 a year. Now, does that mean that's wrong? No, the company in question's lucky that time, but I would expect a sharp correction.
That makes, okay. Yeah, that makes sense. You could see that. I think that happens in a lot of cases when things boom or going, you think they're going to continue to boom and go and everything is great, fine and dandy. And you can try to do that maybe from the standpoint of solidifying business or increasing business, but you're right. Eventually your pendulum's out, never stops swinging. And eventually it swings back to the other side.
What do they say? What goes up must come down.
What goes up must come down. What goes up exactly must come down. Just on some of that, I know you hit a kind of a cause a little bit too with the with rate increases within reinsurance, for example, and other restrictions within reinsurance markets. Can you just elaborate a little bit for us on kind of the role that reinsurance now plays in the market? Even just kind of the maybe those type of backstops now are more common or more desired now from the standpoint almost like your insurance package, so to speak, is being insured again?
Yeah, absolutely. So as far as reinsurance goes, most of the time individual companies will never actually see it affect them. They'll see the rates higher, but they'll never actually see something like facultative reinsurance as a line item. Now, I know some carriers do. I know specifically I've seen it on AmTrust's declaration pages as far as premium charged for, where that is considered facultative reinsurance. So it's not the overarching agreement. So let me back up. There's two ways to look at it with regards to how reinsurance plays a role. So there's an individual basis, which is on a per insured or per company basis, let's call it, where say they're riskier or whatnot, and they only want to take X amount of the risk, but they have to go to a reinsurance carrier to get reinsurance specifically for this risk. Basically saying, okay, we're going to extend a $25 million property limit. But in that property limit, we're going to only cover the first 6. And we're going to get our own facultative reinsurance for the 6 through 25. So those are times where it affects on an individual account basis. Most of the time, though, there are reinsurance treaties from an overarching perspective for these large carriers as well, where they're looking at it like, all right, so in our underwriting guidelines, we say we're not going to work with cranes whatsoever. So the reinsurance carrier will say, if you write something with cranes, we're not touching it. We're not a part of it. We're not doing it. So that's the way in which it's inhibiting and they're called treaties. So the treaties are inhibiting the underwriting approach at this point. So it's becoming more selective on what risks are approached. Does that help answer the question, or?
Yeah, that absolutely did for me. That absolutely did for me. And were there, I mean, in looking back on it now, as you can obviously see this occurring, and now we can. It's always easier to have that rear view look once you get past it all. But what were the trend points or some of the things in the market maybe that should have been that are realized now that were occurring maybe last year before? That's kind of we're seeing this now as the effect here.
Okay, yeah, and what I can tell you is trend lines. You can just look at underwriting profits and losses. There's not a whole lot of specific detail in terms of what actual trends are outside of looking at what the trending premium has been in certain lines of coverage. So for example, auto is the easiest example to use with new technology in vehicles, distracted driving and things like that. There has been a consistent increase in auto premium for the last 5 years. So has it been dramatic? Not necessarily, and that's why you're not seeing a dramatic increase now on auto. You're just seeing the level increase of between 4 and 6% on an annual basis. Now there are market corrections, of course, as I mentioned earlier, but at the same time, most of the time these increases are nominal in order to try and reset the mean as far as what these autos should ultimately be insured for from a premium basis.
Okay. And you kind of referenced to a little bit, there's obviously some increased signs, for example, in the fourth quarter of 2019. You're obviously seeing some obviously in 20, but I mean, looking back, would you say that some of those signs were building or were there, say, the fourth quarter of 2018, fourth quarter of 2017? Is this was building, or is this kind of just all of a sudden, built up and hit?
So full disclosure, we've been pumping the hardening market drum. We've been beating that drum for probably the better part of 2.5 years. So there are absolutely signs, but those signs ultimately come from the carriers we work with. And it's mostly on an individual insured basis. So say there is a risk where we're trying to be competitive with it. And mind you, we're all in sales here. Everybody's in sales, but we're more directly approached in terms of trying to find new clients on a consistent basis. So if we're trying to beat a rate on something else and the carrier says, okay, we can do this right now to get you the business, but we're going to have a 10-12% increase next year in order to re-level a mean, that has to go into consideration as well. That has to go into consideration because nobody wants a 1-year rental on a client. So at a certain point, that conversation kind of dovetails into whether or not the carrier is expecting the market to further harden compared to anything else, because they're writing things some of the time. This is not consistent, but some of the time they're writing things with the full knowledge that they are lower than they want to be. So that's why my opinion is that this is somewhat more of a market correction, if you will, which I know is probably the worst news anybody wants to hear, quite honestly. But yeah, just because you look at all the other factors that have led into this, kind of explaining how we are here. But at the same time, if it is just a market correction, then this is the way it is. So all you can do from that perspective is try and be the best risk you can to minimize the amount of premium you pay.
Okay. So are there things, or what kind of things are you beginning to see things, for example, within coverage now, and things that are coming up, be it in certain specific lines? Are there certain, the certain things you're seeing now more in property casualty that are kind of a stronger effect, or in the other, or in other lines components? So
I actually have two very specific examples over the last 48 hours on why this has been a challenge. So, and I'm not sure if you want to get into this detail or anything close to it, but at the same time, if I'm going to run long, let me know. Okay. So
go ahead.
Thing one, I have a account that renewed today, actually, and that account is a recycling operation primarily. They don't necessarily do paper shredding or anything close to it, but at the same time, if you have recycling in your name, then carriers look at you like you are the worst. That and pallet manufacturing, basically things that light on fire or can cause fires, they're not thrilled with, obviously, right? So this is a PC9 property, which is protection class. So that is a scale of 1 to 9, or maybe 1 to 10. I've actually never seen a 10, to be honest. So I've only seen a 9. And it just basically means how far they are from a appropriate water source or fire station that could ultimately put out a fire. So this is a 12,000 square foot building. The value on the TIV, or the total insured value of it, including the business income, is $4.4 million. So not a massive property by any stretch, but still enough value there. And PC9, protection class 9, very far away from everything. And it's framed with recycling operations. So that is a cocktail of horror for a lot of insurance carriers, but at the same time, we've been able to get past it for the last couple of years. They were expiring at $17,000. This year, they dropped the business income limit directly from COVID, by the way, from $2 million to $100,000, which drops the total insured value by $1.9 million, and raised the premium by $5,000. And that was just on the expiring. So obviously we had to look for what the business income limit could be elsewhere. So we could not find what is considered a excess business income limit that was affordable. Minimum premiums were $25,000. So ultimately that wasn't going to work. So we found a different carrier that was able to do it. That different carrier, instead of the $2,500 deductible that they had historically, has a $50,000 deductible. That $50,000 deductible also costs them $57,000 a year as the insurance premium for the annual. So as you can see, that is, through rough calculation, 350% increase with a terrible deductible and whatnot. Now, that brought forth a business decision by my client in terms of, well, what can we do for now? Can we can we decide to kind of punt for now, which is ultimately what happened. So ultimately we bound with the lower premium, and we are still in search of that program that is not going to be astronomically expensive for a $4 million property and whatnot. And I think we have that solution uniquely, but it's not the point. And I believe that premium is going to be around 32,000 comparatively. So still an increase, but actually an increase with affordable, or the recognized limits that they need. So that's one situation. And obviously, not all properties in question are going to be a protection class 9 recycling operation that's unsprinklered in a frame building. But at the same time, that is a extreme example, but an example nonetheless.
And that's a tough conversation to have.
It wasn't fun, but bad news does not age well. So at the very least, the number one advice I can give, and I'm sure we're going to get into this a little bit, but number one advice I can give is do this early. Get out early, get started early, perform all your recommendations that you've had historically on any sort of property or any sort of casualty situation. And I'm not talking 90 days, which is relatively standard. I mean, most carriers won't even look at you before 90 days. But 120 days to actually meet with your broker, to actually understand what's going on and how they may be able to assist, either through different services or kind of strategizing on how best to approach this.
So you think you're talking about maybe 120 days from renewal date to start the conversations with your broker?
So essentially start 1/1 for a 4/1.
Probably a real important aspect, I think, within all of this, as this cycle starts to occur, though, is going to be that relationship with your broker and being in real good contact, and also probably being extremely transparent too.
That's the hope.
Okay.
And I mean, transparency works on both sides as well. I'm blessed to not have this issue thus far, but I mean, there are some situations in companies in my past that I've worked with that don't share everything until the last minute. And when they do so, it negatively impacts everything. So at a certain point, transparency works both ways. I'd hope my colleagues from everywhere are operating in the same capacity, where they recognize that bad news doesn't age well, but at the same time, selfishly, if they don't, that may create opportunity for me. So
and within that time frame, though, there are reviews like to assess site risk or other recommendations, for example, into reducing risk, or even trying to evaluate some ideas, try to take out cost. That, for example, you as the broker or as the broker should be able to do or could do, correct?
So I can tell you situationally, depending on what type of account it is, we have different experts, either from the carriers that represent them or from our own internal loss control, that will go out and view the building, provide reconstruction valuations, check different logs, make sure there's safety checklists, things of that nature, to make sure that the risk is as best as we can make it. But at the same time, just as I said before, it's a two-way street with regards to whether or not you're going to accept those. So say you are a business owner of ABC Company. ABC Company, I give you a list of 10 different items. You say, too expensive, not doing it, not doing it, not doing it. That's easy enough. Not doing it, that's easy enough. Okay, I'll spend whatever amount there is to do that. Ultimately, without having that discussion and without us actually looking over that list on what is important, and some of these don't make sense. Some of them are like adding a sprinkler system to a 100,000 square foot building that's going to cost $300,000 to put in. Is that ever going to affect your premium from that perspective? To justify that? Absolutely not. But it's still good practice to have your own material insured nonetheless. You're not hoping for it to catch on fire. So it's give and take with that from that perspective. So I'm entirely on the side of open communication with regards to the loss control recommendations, and not just on a first level basis. If you've been with your broker or your agent for a significant amount of time, they have the loss control recommendations from a historic perspective. So say the last 5 years of loss control recommendations, pull those up. How many of these have we accomplished? How many of these have we decided actively we're not going to accomplish it? Have we maintained what we accomplished in the past? So it just becomes a more inclusive conversation of risk management as opposed to just a, hey, we're going to renew this, or hey, do you want me to market this? And in all fairness, several other larger brokerages have all of these services as well. So this is not just a we're special thing. This is what you should be doing to help try and make everybody happier, let's call it. Insurance companies included.
And with those type of reviews, though, should you just have them? You should at least have that annually from the standpoint of renewal, from the standpoint of doing it. But should you also maybe have them more often, especially now, maybe have them more often during the year too?
I mean, you certainly can. I can tell you that in my experience, and this is deprecating, I'm aware, but at the same time, accurate. People don't really want to look at insurance or talk about insurance when it's not directly in their face. And that's not judgmental. I get it, because insurance was never made to make you money. It's not a profit bearing cost. It is literally just, it's a protection, it's security. So if you look at it from the perspective of, okay, this is all I've built, this is how I want to protect it. Sure, you can have a meeting once, twice, 3 times a year should you want to. But at the same time, if you do it well the first time and there's no changes in operations, then it's not necessarily totally necessary to continue on that approach unless there are the operational changes, unless there are the changes in exposure that need to be addressed, or by request.
Which kind of bring along what guys to the making sure having that trusted insurance advisor, though, as really kind of part of your advisory team as a business owner, so you could relay those things or know those things as they might occur, or things might come up during the year, rather than waiting for that one time a year to talk about or discuss it all.
Absolutely. And quite honestly, there's a bit of a problem within the insurance industry in general, just I think from an optics perspective more than anything, because there absolutely are clients that get it from a advisory perspective, from all that perspective. There are other clients that this is a pure commodity, and that's I'm not going to call that wrong. It's your approach. It's how you look at it. So if you commoditize it, then you're not going to look for making sure that your broker is performing all of these tasks or getting with you to make sure that we're acknowledging these sort of things. Meanwhile, if you look at it as an advisory role, it's hand in hand. It's you make this decision, we have this discussion. Does that make sense?
Yes, it does. But from that advisory role too, though, do you see sometimes gaps or missing pieces, say within property or within casualty or within executive liability that maybe are being missed or not being included?
Absolutely. But put simply, this is no insurance policy is meant to be static. All right, it's a document that can be amended. It's a unilateral contract. The unilateral contract has a premium associated with it. And in those situations, it can be amended, endorsed, excluded in whatever way necessary within the guidelines of the terms and conditions. So and I can use an example as well. I have another client that just recently renewed that they do primarily inspections of large scale properties. They do it via cameras underneath planes, which is pretty cool, but tickles my inner nerd, but that's something else. But with them, they're no longer going to be just doing the buildings. They're going to be doing the parking lots as well. So that is a change in exposure that we learned of after the renewal, at which point we need to check with the carrier, make sure that there is an inclusive enough definition of the professional services, make sure that the exposure is charged for, so there's not any issues at audit, and make sure that there is a general understanding of any sort of concerns that could occur from either a risk management safety perspective or otherwise. Now, luckily, the client in question primarily surveys roofs, so anything is safer than being on a roof. So this ended up being a positive. So I was like, oh, your exposure is going to be on the ground now. That's fantastic. Let's do that. So it was a very easy conversation, but it's not always either. I have a general contractor that's a client of mine that historically has been doing commercial properties that are office buildings, small retail, small chain restaurants, things like that. And then historically, that's all they've done. Well, there are carriers that like those, and quite honestly, most carriers love those. But if you delve into a different type of construction risk, like using, I don't know, residential or habitational, that is a completely different exposure with regards to condos, for example. If you're building a 50-unit condo building and there's one mistake, well, that mistake could multiply 50 times. Then you have a class action claim on 50 different mistakes. So it's a lot riskier to look at that perspective. So one of my GCs, historically, only those cookie cutter, Bank of America's, Chase Banks, Taco Bell's, McDonald's, but whatever the situation is. They have been awarded 40 million or so in habitational risk of commercial, of residential property. So the conversation had to be with the carrier in question saying, hey, so this may be a blip. This also might be the new norm. They don't know what future opportunities could hold. Look at commercial real estate in general right now. In commercial real estate in general, do we know what the office space is going to look like in the next 2 years now that everybody's kind of baited remote work? We don't know what that construction aspect is going to look like. Or is it going to become build outs? I saw in, I think it was Minneapolis, they're turning office buildings into apartments, which is just wild to me because look at that flooring or that ceiling, the tile ceiling. I don't know how that's going to look in an apartment. So I just look at it from that perspective, with regards to changes in exposures, making sure that the insurance carrier is aware, acceptable to it, and it's not just going to be a short relationship. Because ultimately, switching carriers every year is not going to do anybody any services.
Yep, understood.
And Rob, for the record, if you see me going full-blown tangent like that again, either rein me in or let me go. That doesn't matter. I'm just saying, if I need the hook to get back on topic, let me know.
No, you're on topic.
You're
on topic. I think the other thing always kind of plays into this on how it works within this scenario, hardening market-wise, obviously, is that many times if your premiums are increasing, then in many cases you can increase deductibles, or in essence, you're quote unquote really kind of self-insuring on your own how much you're going to cover from that standpoint. So is that typically might still have the same, requisite effect on premiums in terms of maybe trying to keep them in check, or trying to hold back some of those increases, or is this market past that?
So that's actually a very great question. And honestly, it's case by case. It truly is. That said, take a standard deductible of $5,000 on a property risk. And the only reason I'm saying property is because it's the most volatile right now outside of excess, which we can touch on in a moment. But property as itself, let's take a $5,000 property risk. Essentially saying that you're insuring most glass from that perspective, because most glass is going to be less than 5,000. So how many glass breaks can you have? It's analyzing it on a individualized basis, and from the carrier perspective as well, because say you have a commercial property that is just office buildings, and that office building, you have a $5,000 property deductible on that building. Okay, so what's going to happen for $5,000? Not a whole lot. Comparatively, if you raise it to $10,000, what's going to happen at $10,000? Still not a whole lot. So it's all about trying to identify at what point that exposure lessens. And I can tell you from 5 to 25, most of the time that does not lessen much. So you get some premium credit, but it won't be nearly as dramatic as anybody would like it to be. Really, if you want to talk about having a real SIR or self-insured retention that drives down premiums, you really have to get in the neighborhood of 50, 7,500 up to 250,000, which becomes true self-insurance at that point.
Yeah, that would. It's almost not. At that point, you got to really question the benefit of it too.
Agreed.
And obviously, you said you'd have to have the size and the reserves to be able to handle that.
Without question. And most of the time, there's a different component of that as well, wherein it's no longer talking about just having a raised deductible, raised retention. what insurance carriers will make sure you do at that point is post collateral. So you'll actually have to post collateral in form of a self-insured retention and make sure that you can cover it in the case of a loss. So say, and the term for this is loss sensitive. So loss sensitive programs can start around 100,000, but most of the time they're 150 to 250,000 and up from an SIR perspective or self-insured retention perspective. So prior to those entry points, you don't have to worry about collateral. You don't have to worry about, posting a bond to make sure you can pay it or anything close to it. But once you get to that level, it becomes an actual financial underwriting that you can actually sustain a loss like that.
Yeah, that brings about entirely, it's like a entirely different perspective or entirely different, I don't know, your mindset in terms of reviewing that or what you want to do or how to combat it.
Which ultimately could be a positive with regards to identifying not just the broker as a broker partner or an advisor partner or as whatever role they need to play in an advisory perspective, but also looks at it from a carrier perspective saying, look, we're partnering with you to say that we don't want to insure you if you can't cover 250. If you can't cover 150, then it doesn't make sense for us to try and put it on here because it's just going to be a catastrophic loss one way or another where you're not going to reach the retention point. So there's going to be no coverage one way or another if you can't pay your deductible to that level.
So with that too now though is there a different effect or different kind of priorities to keep in mind relative to, let's just say with merger and acquisition or M&A activity in terms of the due diligence that has to be done there or a business that's kind of in exit strategy selling mode? Does any of this play into that type of scenario too, or you just need to have it set and be ready?
It does play into it only so far so as understanding what company A and company B are. So acquirer, acquiree, if the acquirer is substantially larger than the one being acquired, then obviously that's just going to roll in and they're going to maintain the same structure. That's not going to be an issue. That said, I can tell you it's very rare to see the level of retention that I'm discussing, at least in the Northeast Ohio marketplace, at least at this time. Now, at a certain point, I imagine my leadership will watch this, and not sure how they'll feel about me saying this, but I don't think insurance is the solution for everything. You have to identify what retention you're comfortable with, because if it's about what you're comfortable with, then you're not looking at it as just a continuously increasing cost that you're having to pay for. It's looking at it from the perspective of, okay, what loss can I retain? What loss so that I don't have to pay the premium for this or anything close to it, which also kind of segues perfectly into another option of what you can do, which is captive programs. Now, whether this is the single parent captive, which is primarily casualty lines, which are liability, but simply whenever I say casualty, it makes me feel like I'm in the death industry. Not quite, but think of it from a casualty perspective. So your auto, work comp, general liability, pollution liability, professional liability, all of those are considered casualty. So with that said, what you can do is you can start a captive insurance company, single parent, and offload some of your risk into that with pre-tax dollars that ultimately operate with you becoming the insurance company. Now, it's backed by company paper at that point. It does have to be in compliance with the IRS, but ultimately, these are ways in which to not necessarily have it be just, I pay Travelers this, I pay Zurich this, I pay blank this. So it allows you more control over that aspect. And ultimately, if you look at the captive structure, and we can get into group captives next, so either heterogeneous or homogeneous captives with multiple companies all paying in with the CEO or the person in charge being on the board of directors for that captive insurance company, which could be 15 companies, could be 50 companies, all with board of directors, all meeting to discuss, retention levels, premiums, and whatnot that they're paying into this. But the important thing to note is that their main focus is no longer about how much they're paying the insurance company or how much they're paying the captive management company. The conversation becomes, how am I performing safely so that my insurance company, my captive insurance company that I'm a part of, is paying the appropriate dividends? And a weird thing that happens with group captives is that there becomes something of a co-company shaming, which that sounds far worse than it is. But at the same time, say, company A is one of the founding members of the captive, all right? And the deduct or the self-insured retention is 100,000. And basically company Z, which is the last one, so 26 member, right? Company Z comes in and has 5 different hits, all above the $100,000 retention. Then company A, as well as company A through Y, are all looking at company Z saying, what the hell are you doing? Why, how do we fix you? Like, we talked about this. Why can't you get things together here? So it almost becomes a strange community where everybody's trying to become safer together, which ultimately massively beneficial. Because you see the performance of captives significantly outpace standard insurance companies, because the owners have a personal stake in making sure their risk is managed appropriately.
Yeah, it's a similar structure and similar way a couple of the workers' compensation programs work relative to, particularly relative to retro group, and then discount group rating as well. So it is kind of that same concept where you're going to be dependent upon everybody in the group is where you're going to be able to drive from it, and you may have to want to try to do some things to hope somebody with with an issue can do some things to correct that issue. So I will say that those listening and viewing, if you have any questions or comments, obviously you use the chat or use the Q&A section for anything that you'd like to throw in on from that standpoint. So I think we have covered quite a bit of ground in a lot of zones and a lot of areas here. I guess maybe I might say at this point, so from the main points, what do you think? How would you position? What do you think kind of are the main 3 points, the main 3 things to take from this, or to know now to apply relative to your insurance policies, relative to renewals, and relative to going forward?
So the 3 main takeaways I'd like to share. 1, this is an industry problem in total. This is not an individualized problem. Just because company A is having these issues, it's everybody's issue as well. So that's the first takeaway. Second, start early. Make sure to have these strategic and planning meetings early, and make sure to actually have a game plan with how you're going to approach this. If you know that you have a significant auto fleet, if you know that you have a significant property schedule, because these are the 2 main issues, make sure to have these conversations up front, and make sure to try and get terms for renewals as quickly as possible, so that we can appropriately game plan how this is supposed to go. And 3, I had 3 all lined up, and it's escaped me briefly. But third is, make sure to talk to your agent or broker about what different services they can offer to help support this. Now, just because we have something does not mean it's the end all be all. And most of the time, a lot of smaller companies or smaller agencies can actually still provide these services by use of whatever carrier they're representing, because dirty little secret, guys, the carriers don't want to pay out the claims either. So they're going to try and make you safer as well. So when that happens, when they're offering these services and manufacturing risks, if the premium is greater than a certain dollar amount, most of the time they'll provide free infrared scanning to your full manufacturing plant. So, I mean, these are things that are available out there that either people aren't discussing or people aren't doing. And that's, my clients can be guilty of this as well. Most of the time it's reinforcing that message. So make sure to talk to your broker about services that they can offer to help support you in your renewal or appropriate marketing of the risk or anything along those lines. So thing 1, it's not your personal problem. It's everybody's problem. Thing 2, start early. Thing 3, make sure to identify what the resources are and find out the strategic steps to move forward with them.
I think the part you point out is interesting too is obviously it is a bit of a new territory with it because this hasn't occurred from we said since 2001.
Right.
So in many cases, there probably people don't remember that, don't remember going through it, and now what has to be done. And I think it does definitely show a standpoint to make sure that within a business and as a business owner, that you have that advisory board set up, so to speak, and that a big part of your advisor needs to be your insurance agent and broker, and be aware of the service what they can do, and be open and giving from that standpoint, and just things obviously to be aware of. As you said, there are obviously things with this didn't just happen in the last 3 months. This hard market's been occurring and been on that path for probably, like you said, about 3 years almost. So it's now sort of things obviously maybe next time kind of be aware of and to plot and to see, I think, as well, to know what to do, and how this all impacts, because as I said, I think insurance from a CFO standpoint, insurance has a big impact on the business in terms of what you have coverage wise and what that cost is and what's there. And I think I'll just kind of further mention, I think there's my closing points was there's a further mention with Charlie. Charlie does have an article that has been published in Properties. It's the July 2020 edition. It's under NAIOP News. And it is about the considerations to help offset a hard market that Charlie's written, is just recently published. So you can easily find that article and get some other detail from this discussion. So I think I'm gonna, we covered all the bases. That's some of the point you want to put in, Charlie. Please go ahead.
One brief note on the article specifically. Now, as the magazine and the periodical would indicate, it is a properties magazine, so it's going to be geared more towards property. So if you have any questions outside of property, feel free to reach out to Ryan or Rob as far as getting in touch with me or anything along those lines. I think my information was included in some of the correspondence, but at a certain point, I'm very available to share any sort of insight I can.
Excellent. Excellent. Well, I appreciate the time, appreciate the information. I definitely enjoyed our conversation, and I thank you.
Yeah, thank you for the opportunity. It's always fun to share more insurance.
Absolutely.
Yeah. Mm-hmm.
Charlie, thanks for being a part of our network. It's definitely a pleasure to have gotten to know you, as well as quite a few of your coworkers there. So definitely appreciate it and look forward to more. Okay.
Thank you very much for the opportunity. Glad to have you on.
Thanks a lot, guys.
All righty.
Thank you.